Almost everything you've been told about Forex trading is backwards. Most traders believe the secret to making money in currencies is hidden somewhere on a chart, a perfect indicator, a perfect entry, a perfect pattern, but the uncomfortable truth is that the traders who consistently make money in Forex are not looking at charts first. They are looking at the forces that move entire economies. And once you understand those forces, Forex stops looking random and starts looking structured, predictable even. And this is where it gets interesting, because the difference between struggling traders and professional traders is not intelligence and it's not experience, it's understanding what actually moves currencies. Most retail traders approach Forex like a puzzle made of candles and indicators. They search for signals, moving averages crossing, RSI levels, support and resistance lines, and sometimes those things appear to work. You catch a move, maybe a trend, maybe a breakout, and it feels like progress. But then the market changes, the same setup stops working, losses start stacking up, confidence drops, so you change strategy or indicators or timeframes and the cycle starts again. If you've ever felt like Forex works for a while and then suddenly stops working, you're not imagining it. That's exactly what happens when you're trading the surface instead of the underlying drivers. Because currencies don't move randomly, they move because money moves, and money moves for reasons. Big institutions, banks, hedge funds, asset managers are constantly allocating capital across the world. Trillions of dollars flow between countries depending on growth expectations, interest rates, inflation, and risk conditions. These flows are what create currency trends, not indicators, not patterns, real economic forces. And once you see this, you start to realize that charts are not the cause of price movement. Charts are the result of price movement. The market moves first because of macroeconomic forces, and the chart simply reflects what has already begun. This is the part most traders never realize. They are trying to predict price using the shadow of the move instead of the source of the move. Think about currencies like a tug of war between economies. Every currency pair is a comparison: the euro versus the dollar, the pound versus the yen, the Australian dollar versus the Swiss franc. One side strengthens while the other weakens. The question is always the same: which economy looks stronger and which one looks weaker? This is why macro trading works. Because instead of guessing where price might go next, you're analyzing the forces that make price move in the first place. And once you start thinking like this, Forex suddenly becomes much more logical. Now this is the part nobody talks about. The single biggest driver of currency markets is interest rates. Interest rates act like gravity for capital. Money flows toward higher returns. If one country offers higher interest rates than another, global investors have a strong incentive to move capital there, and when capital moves into a country, its currency strengthens. This explains almost every major currency trend. When the United States began aggressively raising interest rates, the dollar surged, not because of chart patterns, but because global capital was flowing into dollar-denominated assets. Investors could earn higher yields holding dollars than holding euros or yen. The macro forces created the trend, and the charts followed. But here's where it gets even more interesting. Markets don't move based on today's interest rates. They move based on expectations of future interest rates. Traders are constantly trying to anticipate what central banks will do next. Will rates rise? Will they fall? Will they stay high longer than expected? These expectations shift capital flows long before official decisions are announced. And this is why news events sometimes seem confusing. So a central bank can raise interest rates and the currency falls. That happens because the market expected even more tightening. The expectation changed and the currency moved accordingly. Once you understand that currencies move on expectations rather than headlines, a lot of confusing price action suddenly makes sense. But interest rates are only part of the picture. Economic growth matters as well. Stronger economies tend to attract investment, businesses expand, consumers spend, employment rises. All of this creates demand for a currency. If investors believe one country will grow faster than another, capital tends to flow toward the stronger economy. Inflation also plays a role. Rising inflation often leads central banks to tighten policy. That can support a currency, but if inflation becomes uncontrolled, it can damage confidence and weaken a currency. It's always about context. It's always about the bigger picture. And then there's global risk sentiment. This is something traders underestimate constantly. When markets feel stable and confident, capital tends to flow toward growth-oriented currencies like the Australian dollar or the Canadian dollar. But when uncertainty rises, financial stress, geopolitical tension, recession fears, capital moves towards safe haven currencies like the US dollar and the Swiss franc. These shifts can drive massive moves across the Forex market. This is why Forex trends often last for months or even years. Macro conditions change slowly. Interest rate cycles unfold over long periods. Growth divergences persist. Capital flows build momentum. Once a macro trend begins, it often continues until the underlying conditions change. And this is the breakthrough moment for many traders. But instead of trying to predict every small move, macro traders focus on the big forces that drive sustained trends. They are not trying to win every trade. They are positioning themselves alongside the dominant macro environment. Professional traders think in probabilities, not certainties. They ask questions like which currency has the strongest macro outlook and which has the weakest. Where are interest rates likely to rise and where are they likely to fall? Where is growth accelerating and where is it slowing? Where is capital likely to flow next? These questions form a structured framework, and that structure creates consistency. This is exactly the approach we use inside MacroDrivers. Instead of trying to interpret dozens of disconnected indicators, the platform tracks the macro forces that actually move currencies, currency strength across major economies, shifts in macro trends, changes in the global risk environment, all the things professional traders monitor every day. And what's interesting is that once you start analyzing markets this way, charts begin to make more sense rather than less. Technical analysis becomes a timing tool instead of a prediction tool. Instead of asking what the chart might do next, you're asking whether the chart is aligning with the macro picture. That alignment is where high probability trades tend to appear. Trading changes when you understand this. You're no longer reacting emotionally to every move. You're not chasing signals. You're not switching strategies every few weeks. You have a framework. You understand why markets move. And that confidence makes a huge difference. Most traders never reach this stage because they never move beyond surface level analysis. They stay focused on short-term signals while the real drivers operate underneath. But once you start thinking in macro terms, Forex stops feeling chaotic. It starts feeling structured, logical, understandable. And this is why macro trading is the only Forex strategy that consistently works over the long term. Not because it's easy and not because it's perfect, but because it aligns with the real forces driving the market. If you're serious about improving as a trader, the most important step is understanding what actually moves currencies. That's exactly why MacroDrivers exists. It's designed to track the macro forces shaping the Forex market, currency strength, macro trends, and global risk conditions in a structured way that reflects how professional traders analyze markets. Once you start looking at Forex through a macro lens, everything changes. Markets become clearer, trends make sense, decisions become more confident, and trading stops feeling like guesswork. Forex will always involve uncertainty. No strategy removes risk completely, but understanding macro gives you something most traders never develop, a real edge based on how markets actually work. Because once you understand the forces driving currencies, Forex stops looking random and starts looking like opportunity.